Welcome back to the My Latin Life podcast. Since 2014, My Latin Life has been your trusted guide to traveling and living in Latin America. My guest today is Alex McGowin from McGowin Tax. He's based in Mobile, Alabama. And this call today, guys, you would have to pay $500 an hour or more in order to speak to Alex and hear the things you're about to hear on today's podcast. So hopefully you guys appreciate how valuable this session is going to be. But without further ado, Alex, welcome to the podcast.
Yeah, appreciate it. Thanks for having me, and excited to talk about some tax. Everybody's favorite topic, right?
Absolutely. Hopefully I didn't lowball your hourly rate. Maybe I should have said a thousand an hour. But
No, you're
so
good.
for the audience, what we're going to get into today, we were thinking about two different topics that we're going to do. One is going to be, the first topic is going to be Americans that own foreign corporations and foreign real estate. And that's always been an area with a lot of questions. Like, let's say you have a Mexican company or a Costa Rican company, what that looks like as an American. And then in the second half of the hour we have together, we're going to talk about the US filing requirements for US LLCs for non Americans, essentially non US persons earning income from the United States. My Latin Life, we help people spin up Wyoming LLCs and so forth for Canadians and Europeans. And in this episode, we'll talk a little bit about your obligations for having a Wyoming LLC or something like that. Does that sound good, Alex?
Yep, sounds like a plan.
Cool. So let's definitely talk about. We'll start with the Americans. I'd say like more than half our audience is American, so we'll
Right.
start with the American stuff. And I'm American. I've always personally been afraid of having a foreign company because I just know it comes with insane filing requirements. And I think there's something called a CFC, like a foreign controlled corporation, something like that. And
Right.
so I've always been told, like, if you're just a small fish, don't even bother with foreign corporations. It's just not worth the headache. But maybe you can help kind of unpack what things would look like.
Yeah, and I think that's a good, because you can kind of, if you don't understand the rules, there's kind of two approaches, right? There's you go about it anyway, and you usually get yourself into trouble. But I think, yeah, it's a good strategy maybe to stay away from it if you're not sure. But you can definitely use them. You can definitely use foreign companies and it not be a major U.S. tax situation I guess, if you go about it the right way in the beginning, like anything. But I mean, as a general rule, the most common misconception with like a foreign company is it doesn't work the same way as a US LLC as far as the default status. I mean, there's exceptions to this rule, but as a general rule, if you set up if you set up the non-US version of a limited liability company, the default is a foreign corporation. Whereas in the US, it's very common, right? If you get a rental property or you want to start a business, everybody tells you to set up an LLC. It's very easy to do, protects you from liability, and there's legal reasons to do it. But it's a flow through in the US. So if you just set up a single member LLC and you don't do anything else, the income from that business in the US flows directly to your personal tax return. And when you have a non US LLC, it's the opposite. It's a foreign corporation unless you elect otherwise. I mean, that's the basic rule. Um, and then, there's options from there. So then we look into is is that default result a good thing for your situation or is it a bad thing? And that's where we kind of get into the specifics of each person's situation.
Okay. Could you outline maybe some pros
Yeah.
and cons? I guess are you saying you could elect a foreign corporation to be, or a foreign entity to also be a pass through?
Yeah, exactly. So I'll give you a few examples. I mean, like you said, you get a lot of questions around real estate, and a lot of what I do is, Americans investing in foreign real estate or
Hmm.
moving to those foreign countries and investing in the real estate. Costa Rica in particular, Mexico, I do a lot of work with. Mexico has its own funky rules, but generally, just like in the U.S., there are non-tax benefits to investing through a local country business limited liability company. Like in Costa Rica, it's an SRL. I think it's called the same thing in Mexico. A lot of Latin American countries have the same setup. But the whole concept of it is it provides limited liability. Now, if you don't do anything, like I said, and let's say in the real estate example, what would happen is it's a foreign corporation now. You own it personally. And the only way you're supposed to be taxed on that is if you take a distribution from that company. So as opposed to it's not going to go in your personal return as income, but if you set up a Costa Rican bank account for that company, you're only paying tax when you take money out of that company personally as a dividend. The problem with that is that there's all kinds of anti-deferral rules, and that gets a little complicated getting into each one. But that's where the CFC concept. So when you own more than 50% of a foreign corporation, which this would be, it's a controlled foreign corporation, and that's where these complicated anti-deferral rules can get set up. But as a general rule with real estate, I would generally advise my clients to make an election to treat it as a flow through, which is something you can do. So
Mm.
you can proactively treat it like the U.S. rules. There's some they have entities called like per se companies that you can't make this election for, but it's generally like publicly traded type companies. I mean, you definitely want to check before you just assume you can do it, but you generally can. And the benefit of making that election is it makes it simpler because it acts just like it would as a U.S. rental property. Depreciation's a little different. You have a higher uh, life for the depreciation, but otherwise it works just like the U.S. Rental property would. And you get to take advantage of losses. So that's the big thing with rental properties is that if you keep it in a corporation, and let's say with depreciation, you have like net losses each year, and then you turn around and sell the company. Generally, you're supposed to be able to take those losses and offset it against some of that gain. But if you have it in the corporate setting, you wouldn't be able to. You just lose out on those losses. So that's why I like to usually make that election to treat it as a flow through, especially in a rental scenario.
Hmm. Yeah, we get questions like this a lot. We have a couple Telegram groups, and these are questions that come up a lot in our Telegram groups. So, I guess random side note for people listening, there'll be a link to the Telegram groups in the show notes, and you can join. There's like thousands of people in there trading expat tips and stuff.
Yeah.
But I personally spend a lot of time in Mexico, and I rent because I'm afraid of what happens when I buy and just complicating the shit out
Yeah.
of everything. So when you say elect maybe a pass through in Mexico, is do I then file a Mexican tax return? I'm assuming on any Airbnb profits or rental profits, or does it pass through directly to the U.S.?
Oh, yeah. Good question. So this election, it's solely a figment of U.S. tax imagination. And
Okay.
what I mean by that is, if you set up a Mexican company, it's a Mexican company for Mexican tax purposes. So it's going to
Hmm.
have whatever filing requirement it has there. But then, if you make an election to treat it as a flow through, that's solely a U.S. tax concept. So that just means for your U.S. tax return, it's going to be treated like a flow through and come onto your personal return. There is a separate like entity form you have to include with your personal tax return, but if it's a Mexican corporation for Mexican tax law purposes, then it's going to be or whatever the LLC filing requirement is for Mexico, it would be the same regardless of the U.S. election. Does that make
Okay,
sense?
that does make sense.
I mean, what's
Okay.
unique about Mexico, and I mean, I I have people in Mexico that I refer to to get their specific knowledge when it comes to their laws. But I know when you purchase property in Mexico, as a non-citizen, I don't think you can hold it all directly yourself. There has to be either the bank holds ownership in the property to some extent, or you have to have some type of Mexican partner. So a lot of times it turns into like a
Uh-huh.
partnership. scenario.
Yeah, on the coast, and you have to create the trust called the fideicomiso
Right.
within 50 kilometers of the coast. But if you were in, say, Guadalajara or Mexico City, you could own it free and clear in your name without a corporate entity.
Oh, really? Even as like as a non-citizen of Mexico?
Yep.
Okay, I didn't realize it was purely coastal related. I guess that makes
hmm
sense. Um, Interesting. Okay, yeah,
And
I
then
just want
so
to.
I'll cue you here. So and then a lot of people say, well, if I can, even with the fideicomiso on the coast or just owning it in your name, maybe in Mexico City, a lot of people say, well, what if I own that through a US LLC? Is that a good way to go about it and just have literally no Mexican entity and just own a condo in Mexico City through a US LLC? What would you think about that?
Yeah, and without the foreign company, just the
Yeah.
LLC owning it.
Yeah,
Yeah,
just straight up.
yeah. I mean, unless there's really no tax benefit to having it a U.S. tax benefit to having the foreign entity. To be honest with you, I mean, in a rental scenario, if there's no income, well, even in that scenario, yeah. I mean, having the foreign company does just kind of, to your original point, kind of complicates the U.S. tax rules. And the election I'm talking about is to get you back to the normal U.S. tax rules, so you don't have the complication. So I
hmm
mean, if there's no non-tax benefit in the local country to having the the foreign entity, then it doesn't make then you don't yeah, then I don't see a benefit to having it. But because there's not a tax benefit specifically. But I mean, having it through the US LLC, um, I mean, it adds a layer of protection at the end of the day. I mean, some people, what I like to do sometimes is keep the foreign property or the foreign business off their personal US tax returns altogether. So, like with a married couple, say that owns wants to have a rental property in a foreign country, they can kind of set up both at the same time. They could have a partnership, a U.S. partnership that owns the foreign property, and maybe they own a foreign property through the foreign company as well. And then it keeps it totally separate from their personal U.S. tax return. I mean, you kind of start to complicate things a little bit just having more tax returns you have to file.
hmm
But it adds a layer of, I guess, distance between the foreign property ownership and yourself.
Okay. So, if I wanted to buy a house in Mexico City, should I do you think I should use maybe a Wyoming LLC for extra protection or just not bother and just own it straight up in my name or
Yeah, from a tax perspective, I would just own it straight up in your name. I don't see a particular benefit of having it in the company personally. But I guess, I mean, there could be legal reasons why, from a limited liability perspective. Um, yeah, I guess my answer is it makes no difference from a tax perspective which one you own it in. I guess it gives you a layer of protection that could be good for non-tax reasons.
Mhm.
So more broadly, yeah, I would put it in an LLC. I know I just kind of said the exact opposite of what I originally said, but I guess that's kind of my point. Is that from a tax perspective, it doesn't really matter, but it
Uh-huh.
probably does benefit you from a legal perspective to have a legal entity separating you from the property.
Okay.
Yeah.
I'll switch things up a bit. So I heard from a Costa Rican lawyer that there's some sort of treaty with between the U.S. and Costa Rica, and you can have these Costa Rican, I guess, business entities that are maybe like owned by the U.S. entity, and it can be like a zero tax thing. And there's some treaty. I didn't investigate this too much, but do you know? Have you heard something about that?
Um, well, with Costa Rica in particular, there's no treaty with the U.S. There's no income tax treaty between Costa Rica, and there's no the similar thing with the treaty is the totalization agreement, which is kind of like a treaty with self-employment tax. But yeah, I don't know about that. There's no treaty between the two. Was it trust related or company related?
think it was company related, like because you can create like branch offices of U.S. companies
Mm.
in other countries. So you could have a Mexican branch company and a Costa Rican. So I heard something about the Costa Rican one. I didn't investigate it much further, but I don't know.
Okay. Yeah, no, I need a little more context there to see exactly like what that could be. But it wouldn't be treaty related because there is no treaty. So it'd have to be
Okay.
something else.
Well, and I guess just continuing on this thread of maybe things that Americans should be aware of doing business in Latin America from a tax perspective and just in general. What have some of your big epiphanies been? What have been some of your learnings in your work at McGowin Tax regarding kind of what maybe things to avoid or benefits that people weren't aware of doing business in Latin America?
Yeah. Yeah. I mean, I think the main thing I deal with people that are have earned income, either self employment income, their own businesses, or their employees. It's navigating that foreign earned income exclusion and trying to using it to the best that you can. And
Hmm.
one of the tricks too is that you don't have the totalization agreements in most of the Latin American countries or tax treaties. So you're purely based on the U.S. tax code to get the most efficient tax rate you can. So with the foreign earned income exclusion, and just briefly, I mean, right now it's like 125,000 dollars that you can exclude of your earned income. So that's income from wages or self employment. But where I where I see some people underutilize that is when they move to Latin America and say they're self-employed and they have the strategies that worked in the U.S. don't necessarily work as well when you move abroad because of this exclusion. For example, what I've been seeing a lot randomly, or not randomly, but recently, is in the U.S. a person would set up an S corporation, and the whole benefit of the S corporation is to limit your exposure to self-employment tax. So if you make $100,000 in your business, if it wasn't in an S corp, you would pay income tax and self-employment tax, which is up to 15-ish% additional tax. The S corp allows you to pay yourself, a minimum or a reasonable salary, and just the salary piece is subject to your FICA. Self-employment tax is just FICA and Medicare tax when you're self-employed. But so all of the income above your wage amount is not subject to that self-employment tax. So that's the benefit of the S corp. The problem is when you move abroad, your biggest benefit is not necessarily the removal of the self-employment tax, it's the foreign earned income exclusion to remove all your tax, right? So or at least your income tax. So the problem is the two work against each other in that if you have an S corp, when you're in the US, you're trying to pay yourself the lowest reasonable salary so that you can avoid as much self-employment tax. When you're abroad, you're trying to get as much earned income, so salary and self-employment income, as you can to maximize the foreign earned income exclusion. And the way the rules work is when you have an S corp, the only piece of that earnings that's considered earned income is the salary piece. So in my example, if you're earning 100 grand and paying yourself a salary of 20, that's good when you're in the US because you've avoided, self-employment tax on the 80,000. But then if you move abroad, you've minimized what you're able to exclude on the foreign earned income exclusion to the 20,000. You can only exclude the
Hmm.
20,000 instead of the whole 100. So I guess what I've found with when you have like an S corp scenario, a lot of cases it doesn't make sense to continue having the S corp,
When you
or
go abroad.
when you go abroad, right? Or you can pay yourself a higher salary, and so you can exclude that amount. You're trading income tax for self employment tax in that case.
And then what do you think's the best thing to do in excess of the 125K?
Um, yeah, I mean, it somewhat depends on whether you're paying tax in the country, in your resident country or not. You know, because some, like if
Uh-huh.
you're
Let's
living,
assume not. Let's assume not.
yeah. So if you're not paying tax in that country, yeah, there's not a good way to necessarily shield that other than, um, I mean, especially in a flow through scenario. So if you're owning it directly, yeah, you're going to pay tax on that additional amount. There's not really a good way to get around that piece. I mean, one thing I like to do, as opposed to like an S corp or just owning it directly, what I've done recently with some people is actually set up a foreign company. And I know I just said don't set up a foreign company, but you can if you do it strategically, like I'm saying. So it would
And then
be
you and then keep the excess as retained earnings in the foreign company.
well, that'd be one way to do it. But well, let's say, I guess first, if you're under the 125,000,
Yeah,
one
if
way
you're
you
under,
do,
it's easy. If you're under, it's easy because you just exclude everything, right?
but you're still paying self-employment tax. So the strategy I use to avoid that is you don't have to, a foreign company doesn't have to pay self-employment tax to someone working abroad. So if
Uh,
it's your company and you have an employment arrangement with your own company, and so you're paying a salary in that local country, then you can not pay any U.S. self-employment tax or any U.S. tax if it's under 125. The only problem is then you get into local country rules with payroll and things like that. So you have to, but
yeah, yeah. And so historically, what a lot of people have done that I'm aware of is they would have like a US LLC owned by like a IBC, like a offshore business corporation from,
yeah,
whatever, Belize or BVI or something like that. And then I guess it's and then yeah, and then they kind of get around the self-employment tax that way.
right, because they pay it up to the foreign company and then it comes out. Um, yeah, yeah. I mean, I guess to your other point, I mean, it's kind of similar to your other point of what if you have the foreign company leave the earnings in there as opposed to paying it out. Uh, that's where it gets a little complicated with these anti-deferral rules. Like when you have a foreign corporation and you're the 100% owner as a U.S. citizen, the old rule and the way it used to work is that you didn't pay tax on that income until you pull it out as a dividend. And there were some other like anti-deferral rules, but they were pretty easy to navigate around. But then when the Trump tax cuts came in, they implemented, this concept called guilty. I don't know if you've covered that much here on the podcast, but
No, I've never heard of that.
yeah, so it's very aptly named, right? That it stands for it's the worst name in the world, but it's called Global Intangible Low Taxed Income, and that stands for guilty. And the whole concept was when in 2017 the Tax Cuts Act, it wanted all the foreign companies because you have to remember they're focused on, like, the policy around foreign corporations is focused on these mega companies, right? And that's what's crazy about the foreign corporation rules is that there's no threshold. Like you have to file the same form, and there's the same nuance and complexity for my client who's a piano teacher in the UK and makes £4,000 a year as Apple's subsidiary in Ireland. It's the same form and same stuff. There's no, um, I don't know, phase out, but the whole idea was there was, under that old rule where you don't pay tax till you pay the money, bring the money back.
Hmm.
The U.S. wanted that money back into the U.S. whether they pay tax on it or not, because they want it back into the economy. So the way Trump said, you can bring all that money back tax free, but we're going to make you pay tax on it today under this transition tax concept. So they had to pay tax on all their old retained earnings. But that was kind of the carrot, was like you can bring all your money back tax free going forward. But the stick was this guilty concept where they said if you own a foreign corporation and it earns intangible income, then you have to pick it up as income today, whether you distribute it or not. And that's what GILTI is. And they define intangible income by any income in excess of, and this is confusing, but any income in excess of 10% of your depreciable property. So if you have a business that has, a depreciable asset, a building or like, furniture, you can earn, the IRS is basically saying that if you earn more than 10% of the cost of that building as income, then it must have all come from intangible assets. So if you're a service business with no assets, it's all GILTI. It's all intangible in their eyes. So in your example, where you have, if you leave the money in the earnings in a foreign corporation, it's probably going to get caught up in this GILTI concept and be subject to tax anyway, whether you pull it out as a dividend or not. I mean, there's some exceptions. There's like a high tax exception if you're paying enough tax in the foreign country on the corporate side, but then it's like, then it kind of defeats the purpose in the first place if you're already paying the tax in the foreign country. So that's why, I mean, it's tricky with foreign companies, honestly. Like with controlled foreign corporations, you know, there are some elaborate designs you can do with like intellectual property and
Mhm.
different jurisdictions, but it's really hard to navigate it simply and not pay tax currently on the earnings.
This episode of the My Latin Life podcast is brought to you in part by Crema Social. Crema Social is like TikTok for international dating. It's an app you can download right now on your phone, and 3 out of 4 people on Crema are single women. The app was founded in Colombia, so unsurprisingly, there are a lot of Latinas on the app, by the way. So, how does it work? Crema Social is a social meal experience where you invite a hot girl for a lunch date via video call and food delivery. New concept, so you'll have to try it out for yourself, but this is probably the best way to meet Latinas before you visit the country. So if you're in Latin America or planning to visit Latin America, download Crema Social now and start getting dates right away. There will be a link in the description to download, or just search Crema Social on your favorite app store. Have fun, guys. This episode of the My Latin Life podcast is brought to you in part by Bit Refill. Bit Refill is the best way to spend your crypto in Latin America. Purchase gift cards or mobile refills from more than 3,500 brands in 186 countries instantly, safely, and privately. You can also apply the code MyLatinLife at checkout to get 10% back on your first purchase. Go to bitrefill.com for more information. This episode of the My Latin Life podcast is brought to you in part by Job Stacking. If you are a remote or hybrid worker looking to maximize your earning potential, then Rolf Holtze, the author of Job Stacking, guarantees you'll be able to double your income. This is the exact system Rolf has used to take his own income and those of many others beyond $20K a month. So what is job stacking? It's this idea of working multiple remote jobs. You might have heard Rolf, he's worked 5, 7, even 9 remote jobs at the same time before. And by the way, job stacking works equally well for non-technical roles. So no, it's not just for the nerds. So if you're ready to job stack, then book a discovery call with Job Stacking and see how they can double your income in just 9 weeks. In the show notes in the description, there will be a link where you can book a call directly on the Calendly of Job Stacking and be talking with them as early as tomorrow about how to double your income as quickly as possible. Let me ask you one more question before we flip things to talking about non-U.S. citizen obligations. But I have one more question for Americans. So lots of Americans are abroad, expats, digital nomads. That's kind of my audience, and they see opportunities in the local economy, right? Maybe a dude wants to start a restaurant in Argentina, or he wants to start a tour company in Costa Rica, And
Yeah.
then there's money to be made, but they're just kind of like, if I have to have like a foreign corporation, and just like it's going to be insane with like the double tax and the treaty, and I probably got to pay my accountants way more money, maybe just forget the whole thing, even though there's money to be made. And I know we should focus on making money and not the tax, but sometimes it just seems very punitive.
For
um,
sure.
so, so I was just wondering, like, what do you kind of think if I have the opportunity to start a restaurant in Argentina, and I'm pretty sure it's going to be profitable? Like, how should we go about that?
Yeah, I mean, to your original point, before I go to that exact example, though, is that I hear that a lot from people. Like that's, and it's unfortunate because it holds a lot of people back from doing things they want to do. And one thing I'll say, which is a little bit controversial, maybe, and not in my best interest, but you don't always have to hire an expensive accountant or lawyer to do some of this stuff. Like, I mean, one thing there's a lot of fear mongering in this business that bothers me. And I see it just because there are high penalties for doing things wrong. But, just as an example of like trying to save some money on tax preparation fees, like things like the FBAR, the foreign bank account report, if you have foreign banks, like you can do that yourself online very simply. Maybe get somebody to do it 1 year and show you how to do it
Yeah, I've
and
done
do
the
it, do
FR.
it
That's really really easy. Yeah.
It's really easy. And I see people out there charging thousands of dollars for FBARs. And it's just like, get multiple quotes on things and see what's possible to do yourself, I would say. But as far as like a business, if you have a foreign business, that does get a little complicated, and definitely like in the first year you do it, you're not going to know what to do if you've never done it before. So my advice, like in your example, would be if you don't need a foreign company, you know, don't set one up because that is going to add complexity and cost to your tax return in the U.S. And if you do set one up, I would suggest making the election to treat it as a flow through, which again adds cost on the startup side because that's going to be another fee usually to make that election from somebody. So, I mean, that would be my advice on the front end is if you can avoid setting up the company, it doesn't benefit you from a non-tax perspective. I wouldn't set it up. Be a sole proprietor of some kind, or set up a U.S. company. If it gives you the same non-tax benefit, because that's not going to complicate your tax return any. Um, yeah. Otherwise, if you need to set up a company and it benefits you in the local country, then then get multiple quotes from people to see who can help you. Because some people have standard rates, regardless of the complexity of the forms, and then other people will take that into account if it's simpler. So look around before you settle with somebody. That's what I would say.
Awesome, good advice. Bop, bop, bop. I make a little thing on the audio file so I can tell where to cut it, and there would be an
Okay.
ad here. Don't forget to cut here. All right, Alex. So now we're back with the second half of the podcast, and we're kind of going to be talking to a different audience now, which is going to be non Americans. So probably Canadians, Australians, and Europeans. And they're probably, I'm guessing, leaving their high tax, angry country, and maybe they're getting tax residency in a place like Paraguay, and they have sort of a low tax setup. And part of what we preach is you get the low tax setup, and you get a U.S. LLC as a non-resident, and then that basically flows through, and you kind of have generally a zero tax setup. Um, I think a lot of people are unclear about the filing requirements for having a US LLC as a non US person. So I know there's like the FinCEN reporting that they just added
Right.
in the past year. I heard something that they were like going to repeal it, or is it still on? Where are we at with the FinCEN one specifically? Do you know?
Yeah, the BOA report, and honestly, I've already forgotten, or BOI report. I've already forgotten what that even stands for. Beneficial Ownership Information Report,
Yes.
I think.
Sounds about right.
Um, Yeah, I mean, it's like a lot of things. There's a lot of talk about it being repealed, but the last I heard is it's. Um, I don't have a lot of faith in it going away, to be honest. So if I was at this point, I was kind of holding off to see what would happen to the extent I could, because I think the rules, you have 90 days if it's a company set up in 2024, and then you have until the end of January if it's an existing company that you had before that. Um, so I was kind of holding off. I definitely haven't filed any of the ones prior to 2024 at this point. Um, but yeah, my thought is that they're going to keep it that report's here to stay, just like the annoying FBAR one and the other the other FinCEN forms. I'm a little yeah, we'll see. I'm hoping I get proven wrong, but my indications are that it's a lot of talk about trying to do that, but I don't see any real effort being put into repealing it.
Okay, cool.
Yeah.
And then what other obligations would a non-US person have that has a US LLC essentially as a pass-through entity?
Yeah. Can I say it depends and then just stop there? I'm kidding. So the USLSC, it does kind of depend on what it's doing, as to what reporting it has. The the rules with inbound people, like a foreign person investing in the US, the rules are very antiquated in a way that a lot of like what's considered a taxable presence in the US, because at the end of the day, that's a lot of what's driving what you have to file or not, is whether you have a taxable presence in the US or not. Um,
Yeah.
that
So I would say a lot of my clients are people that we talk to on Twitter. They're not creating the US LLC to invest in the US. They're doing
okay,
it to basically have payment processing to be able to get Stripe and
right,
US banking. And then they're operating their company basically internationally, doing internet marketing or some sort of
right, right,
online stuff. And they want that US LLC and US banking because it's good banking and you get Stripe and all this stuff, and
yeah.
then they're residents of a low tax country where maybe there's zero tax on foreign income and so forth. And so for someone like that just operating sort of a internet business with a US LLC, we know about the FinCEN thing, the beneficial ownership. What other reporting would they have maybe on a annual basis?
Yeah, I mean, generally, I mean, they'd still have an LLC filing requirement itself. And the reason I say, I guess there's two reasons why. I mean, in your scenario, like I said, it's antiquated laws, just in that a taxable presence in the U.S. requires some sort of physical presence here, either an office or people here. And in your scenario, there aren't people here, so there's no taxable presence here.
Hmm.
Um, the If you have a single member LLC, so a non-US person owns it, you have to file a form 1120. Well, you have to file a form 5472, which gets attached to a form 1120 to
Hmm.
report any transactions between the foreign owner and the US LLC. So in your example, if you have a US bank account and foreign owners contributing to that bank account, taking money out, that's going to be reportable in this form 5472, which is filed with that 1120. That's the most common filing requirement in that case, for a client you just described. The I mean, the only other thing is if you have, sometimes I file what's called, protective treaty protective returns for clients, and that the reason the reason they would be filed is if there's any reason to believe they may have a taxable presence in the US because they have sales agents here or something like that, or some type of people physically here, but we're taking a position that there is no presence, then
Hmm.
then you can file a protective return. And the only benefit of that is that if the IRS were to audit you and disagree, you could at least go back and take deductions against that income. If you hadn't filed returns, then they don't allow you any deductions. They just say everything that went through that Stripe account is going to be taxable in the US. So sometimes it's worth it to file that protective return. But like in your scenario where there's nobody here and that's literally all they're doing, there's not really any risk. So I'll say as the other option. So if it's not a single member LLC, then it's actually a partnership, and you have more than one non-resident owner. Then you have a partnership filing tax return in the U.S. Um, and there is no that Form 5472 is not required for a partnership. It's kind of a goofy rule that's only applicable to U.S. corporations that are owned by foreign people or a single member LLC. So partnership doesn't have that 5472 requirement, but the partnership, that's where I file protective returns for the partnerships in most cases, because you just don't want to get in a position where if the IRS were to disagree that you have no taxable presence, that you wouldn't be able to apply any deductions against your income. So in a partnership scenario, I file Form 1065. Maybe maybe it's depending on the country, maybe it's a treaty based return to say there's no permanent establishment in the US under the treaty, or just that there's no taxable presence in the US. So those are those are the main two scenarios. Single member LLC, if you have transactions between the owner and the LLC's bank account, you need to file that 5472. If it's a multi-member LLC, you need to file Form 1065 to take that non-taxable presence position.
Thank you. That was very specific.
Yeah,
And then a lot of people who have US LLCs as non US persons, they also want to get an ITIN, the ITIN, so
yeah,
that they can have personal banking in the US too, right? And have sort of personal credit cards and personal bank accounts.
right.
And I understand that um, you have to apply and not everyone gets accepted and it can take many months and you sort of have to prove activity or a reason to have the ITIN. I understand you file for ITINs on behalf of your clients. How do you ensure a successful ITIN application?
Yeah, so I mean, most of the I-10 filings I do are people that are required to have a U.S. tax return for some reason, and I mean, sometimes you can kind of manufacture that yourself. I mean, you can do like you file the application on a Form W-7, and you'd attach that to the U.S. tax return filing. So that's generally what I do, regardless. Even if it's a blank 1040 NR to non-resident tax return with the I-10. Um, and there's really what makes the I-10 application such an annoying process is that they require documentation to basically prove that you are who you say you are. And so there's there's a few ways you can do that. One is you mail your actual physical passport to the IRS, and then you just pray that they actually send it back to you, I guess. But I don't know that I would ever trust the IRS with my physical passport document. I've never suggested anybody do that route. I mean, and then the other route is what I do for people is that you can, because I'm a certified representative, you can mail me your passport and I can do a video interview with you to document it, and then I can sign off on it, and I'll send you back your passport, and then we can send the I-10 application in. Um, and the but honestly, the easiest thing is to do neither of those. And if you come to the U.S. for some reason, you can go to an IRS taxpayer assistance center. But if you're not in the U.S., you can go to your local embassy, because what you can do is as opposed to sending a passport in, you can send in a certified copy of your passport with the filing. So a certified copy, one thing that's clear is that does not mean a notarized copy or an apostille. It's you have to go to the actual reporting jurisdiction. So you can go to a U.S. embassy in whatever country you're in, and they will certify your passport, and they print out the certification and the signature and the stamp, and then you can give that to me, and I can file it with your application. And that's usually the easiest way, because that way you never have to mail anybody your physical passport, which can be, it's an important document to have on you and not have floating around in the ether. So that's generally the way I do it for people. And then, like you said, it can take a while. Like I've been seeing, like um, in some cases, 3 to even 6 months for them to process I-10 applications. Kind of just depends. But usually, if it's done with the tax return filing, it's a little bit faster than some of the other options. But
Because in the pass through scenario we talked about, people wouldn't really have a tax return, right? So they have to sort of generate activity or a reason in a different way.
right, yeah, I mean, you can still file a tax return. I mean, honestly, I've done it where you file a blank tax return and attach the I-10 application with that and the
Mm.
W-7, and that's worked for me. But yeah, that's generally the way I do it. I mean, there are other options like treaty-based returns, like with the LLC scenario, like a flow-through LLC. I mean, you're technically taking a treaty position, if you're from a treaty country, whether you do the filing or not. So I mean you know, that's what I would do in that case, as a treaty based application for the I-10. So yeah, it's on a 1040 NR. You would attach it to a personal tax return filing, even if that tax return filing has no income or information on it other than your name and address.
Cool, cool. And maybe we glossed over this, but what are the maybe some pros or cons to having an ITIN? Obviously, the pros are you can get, really good U.S. credit cards and things like that. What are some of the cons, if any, of having an ITIN?
Yeah, I don't know that there's any con to having it. I mean, it doesn't trigger, you know, I mean, you could say it gets you in the IRS system, and maybe that maybe that's a con for them to have you in there. But I mean, it's not like they're sending out notices and letters to people just because they have an I-10. You don't have a filing requirement just because you have one every year. It means you had a filing requirement for 1 year, or at least you decided to file for 1 year.
Hmm.
But yeah, there's not a particular negative. I think in my case, if you can, it definitely helps from a banking perspective to have the I-10. And I don't do a lot on that side. I have a colleague that I work a lot with that helps on the banking side. Um, but yeah, I've seen it both ways where they've taken the I-10 has been helpful from a banking perspective, but I thought they've been a little tougher on that now, to where they're actually like requiring social security numbers. Maybe that's just with the bigger banks, um, and not necessarily I-10s. I had a friend that went to Bank of America in Manhattan, and he had an I-10, and they told him they needed his visa document and the social security number at that bank. I don't know that I would, uh, but yeah. So the I-10 didn't work for him with the bank. And that's what's hard about it. It seems like the requirements change on a monthly basis, and it's just so bank dependent on
Hmm.
what they
Even
require.
location dependent. Like
Yeah.
quick tip for people, like in Miami and in Florida, that sometimes they're more relaxed than say in New York.
Right, right. I would think, yeah, yeah, for sure. So it's kind of finding, yeah, what are the good places, and then, but I mean, an I-10 definitely works, but you need to go somewhere that you know that it has a history of working, because it doesn't work everywhere to get bank accounts and credit cards.
One random question. This is basically unrelated, but I noticed this scenario where if you're applying as a U.S. citizen abroad, like if you're an American and you have a baby abroad, and you want to get the U.S. passport for your baby born abroad, they
Yeah.
say like they make you swear an oath that the baby doesn't already have a social security number. And I've never looked into why that is or how that would even work. It's like, can you get a social security number for a baby that's not even a US citizen yet? Like, how does that even, do you,
Yeah. I mean,
any theories there?
that's an interesting question. I mean, I'm sure there's certain visas, because there's certain visas you can get a social security number on, like the student teacher visas, and several others. And some of those visas do stretch down to the children and dependents of the family.
Mm,
So I think that is a scenario like if a somebody was a non-resident, they were in the U.S. on a student visa or a teacher visa, they can probably their children would get some version of that visa and be eligible for a social. So they could have a social. They could. It's possible they could already have a social even though they're not a citizen. It'd be pretty
mm.
rare, uh, but yeah, that's the only scenario I can think of.
And have you ever consulted with people who are maybe Americans with children born abroad who are deciding if they should give their kids U.S. citizenship and maybe the tax benefits of doing it versus not doing it? Maybe you can
Yeah,
claim the baby as a dependent if they're a citizen, but you can't if they're not a
right.
citizen or something like that.
Yeah, for sure. And there's so many factors in that. I mean, because I kind of look at my expat clients like at least broadly in two categories. There's the people that were never really American, and don't really feel American, and then there's the ones that definitely are that moved later in life, and still see themselves and have an emotional tie to the country. So I mean that's part of it to me is kind of it's mostly non-tax in my opinion. Like I tell people that all the time. Like we're with renouncing U.S. citizenship, there's a lot of people pushing renunciation for financial and tax purposes. And I'm not saying that it doesn't make sense for people, but to me, it's a non-tax decision first. And the same with the kids. I look at it as a non-tax decision first. It's like, do you want your kid to be a U.S. citizen? What is your emotional tie to that country? And what benefit it kind of depends on what country you're into. Like if you're in the UK and they're going to have a UK passport, maybe it's not as critical. But if you're in, I don't know, another country that doesn't have as good of a
Sure.
passport system, then yeah, it probably makes more sense from a non-tax perspective. But there's no doubt there's child tax credits that are only available if you have dependents, and there's other credits. I mean, the big thing was back in COVID when you had the stimulus payments and people were getting a lot of money per child.
Ooh,
Um, what'd you say? Yeah.
I'm like, that's yeah, true.
Yeah, I had some clients. I mean, especially I had some clients in Israel. The Orthodox community, a lot of children. U.S. mom with like 9 kids. And
Uh
she's
huh.
getting paid out like 30 grand of child tax credits. She's never lived in the U.S. in her life. And she's getting child tax credits and stimulus payments because of the dependents. So I mean, that's not. It's not that was purely a COVID thing with the stimulus. But I mean, right now the child tax credit's at like $2,500 a person, I think, refundable. So there is a monetary benefit, and it's not available without the social security number. And there's some other more, I guess, nuanced rules that have dependent rules associated, but the child tax credit's the main one.
Right, because if you said, "Oh, I'll let my kid choose when he's 18," well, you just missed out on 18 years times $2,500, which is $45,000.
Right. But you are opening them up to U.S. tax reporting requirements, like the things like the FBAR I mentioned, the foreign bank account report. Like if you have
Mm,
your kids on bank accounts outside the country, then yeah, I mean
trust fund or whatever.
yeah, your
Yeah.
1 year old's filing an FBAR has an FBAR requirement. Obviously, you're signing it, but yeah, and maybe they grow up. I don't know. Yeah, you're locking them into U.S. taxation. But there's ways. There are specific rules for renouncing. Like if they turned 18 and were like, "I never agreed to be a U.S. citizen," you know, then there's simplified procedures for renouncing citizenship in those cases. But yeah, I mean, my simple answer is you're definitely opening up a door to U.S. filing requirements, and there's some child tax credits available, but it's more of an emotional and U.S. connection decision to me than it is a tax one.
Fair. Well, Alex, I'm glad I squeaked in that kind of third topic there. Hopefully, that was something to chew on for people. But Alex, I really appreciate you coming on today and shedding some light on doing business abroad for Americans and then also doing business in the U.S. for non-Americans. I hope the audience can appreciate that there's not too many U.S. accountants and lawyers out there that can really span this breadth of topics. So Alex is a particularly knowledgeable guy, and we thank him a lot for being here.
Yeah, appreciate it. Thanks for having me on. Hope it was good.
Do you want to share any final message before we get to signing off?
Um, yeah, just say, kind of like I said earlier, if you need help with U.S. tax things, don't be too overwhelmed with the filing requirements, or keep that from allowing you to do things that you want to do. There's people out there that can help you at a reasonable price. Look around, or maybe it's something you can do yourself. But yeah, don't let it overwhelm you. Don't be too scared of the IRS. There's people out there that can help.
Sweet. And I'm sure they can check out McGowanTax.com as well.
Yeah, yeah, for sure. I'm happy to help in particular. But if I can't help, I can definitely find people that can.
And I'm sure we haven't pre-planned this, but I'm sure if they mention My Latin Life, they'll get treated extra nice and
Yeah.
get a little discount or something like that.
Right. The Latin life discount. We'll call it that.
Epic. So this has been another episode of the My Latin Life podcast. Again, my guest today, Alex McGowin from McGowanTax.com. Wherever you're listening to this episode, maybe it's Spotify, Apple Podcasts, YouTube, Twitter, be sure to subscribe. We drop 2 episodes a week with amazing guests, just like Alex. And leave a comment, reach out to us. Let us know that you enjoyed the episode. Just to let us know that you're listening and you enjoyed it. Even send Alex a message saying, "Hey, I enjoyed your appearance on the My Latin Life podcast," and we always love hearing from people. So with that, thank you to the audience for listening. Thank you to Alex for joining us. Ciao for now. Hey guys, quick note at the end of the episode here. If you made it this far, you might be interested in working with My Latin Life personally to make progress on your internationalization plan. So whether the next step for you is getting residency in Latin America, lowering your taxes, choosing the best country, maybe a little birth tourism, whatever the next step is for you, of course, My Latin Life can help. We've helped people in their 20s, their 40s, their 60s, because I truly believe that Latin America has something to offer people at every stage of life. So if you want to become our VIP client, if you want to work with Vance, myself directly, book a call. There will be a link in the description. There will be a small fee for the initial consultation, and we do that to filter out the time wasters and focus on the best of the best clients. But if you're listening to this podcast and you made it all the way through the episode, I know you're the best of the best. But we're ready to work with you. So book that call. Hope you enjoyed this episode of the My Latin Life podcast, and we'll catch you in the next one.